Good evening, everyone. Thank you for joining us today. I'm Oyi from ADDX, and I'm here with Ashish Shastri from KKR. Very happy to have Ashish join us today. Ashish is an old friend of mine. We've known each other for 20 years now. Being in the industry, Ashish is a career private equity professional and has been in Singapore for close to that 2 decades. And I spent that 20 years in investment banking, covering Ashish as a banker. And now with ADDX, so happy to have him as a guest on our platform to share with you about private equity, a bit about KKR, and what are the trends that he's seeing in the private equity space in these coming years. Now, Ashish joined KKR in 2016 as a partner and serves as the co-head of private equity for KKR Asia Pacific, and he's also the head of Southeast Asia. Prior to joining KKR, Ashish was the managing partner of North Star Group for 5 years and managed over $2 billion in private equity and venture capital funds with a focus in Southeast Asia. And before joining North Star, he was at TPG Capital for over 13 years. And as I said, a career, long decades of history of investing in Southeast Asia and really watching this space evolve over time. And covering Southeast Asia is very, very complex. We know, sort of looking at it from an investment banking lens, that Southeast Asia is not homogeneous. It's actually a collection of many, many countries with different cultures and languages. So it's extremely difficult to navigate. But when you do that successfully, it really is about building relationships and finding the right opportunities, which I think we would love to get into a little bit. So I'm Oyi, for those who haven't seen me on a webinar. I'm the Chief Commercial Officer of ADDX. And ADDX is a private markets exchange, and we're here to offer private markets opportunities to investors who are on our platform. I really look forward to seeing some of you on our future webinars and talking about different topics, including private equity. We have a whole range of educational webinars as well as deal-related webinars. So, okay, let's get going. All right. So we have a fireside chat going on. I have a couple of questions for Ashish. Just sort of wanted to note that if at the end of the session, if you have questions, please pop them into the Q&A box on the Zoom, and I will pick up as many as I can. I know we have very limited time, but we will try and leave as many questions as possible from the audience. So I'm going to be selfish here, and I'm going to lead with my questions. So here we go. Ashish, first question for you, maybe share with the audience a little bit about KKR, what's the history of the firm and the approach and where it is today.
Sure. So look, I think today when you look at KKR, you would think, most people would think of one of the world's oldest private equity firms. So this is a firm that was founded in 1976. It was founded by 3 gentlemen. 2 of the founders are still alive, Henry Kravis and George Roberts. And it was a typical story where they and their other founder, the 3 of them, met at a restaurant in New York, and they discussed,
as you do,
as you do, and then they wrote on a napkin the plan that they had. The plan was really to solve 2 problems that they had identified. Both of them actually really to do with human motivation. It's actually quite interesting. So the first one was, they thought at that time a lot of value creation in the corporate world in the US could be accelerated if management actually became shareholders. All right, so they thought this was the missing link, right? So why, would management teams not do everything in an accelerated fashion to create value for companies? They thought, well, actually, the minute you make them shareholders, they'll realize it's actually really good for shareholders, it's good for ourselves, and they'll kind of deliver the right outcomes. So they set out to, what they had done in the previous years leading up to 1976 when they founded the firm, was they used to do something that they called bootstrapped acquisitions. So bootstrapped acquisitions is their name for what we now call, private equity, right? And it was basically at that time there were no such thing as private equity funds. So you'd have to go out and find money from people that you knew, investors, and then you'd accumulate the equity. Then you'd borrow the rest, buy a company, give the management team economic incentives, and they would, usually create a much more valuable company. So they thought that, rather than trying to do this at their old firm, which was actually an investment bank, they should actually set out on their own and start it by themselves. The second problem that they identified, and they ultimately did, they raised a $35 million fund. Wow. And they scrimped and saved. They had to go and talk to everybody they knew to do it. You know how much they put in? $120,000. And Henry and George were the younger guys, so they could only put in $10,000 each. They asked their senior partner to put in $100,000. So that's how they started. Their first one was $35 million. The second problem that they had identified was they didn't like one thing about the place that they worked. And the thing that they didn't like, and the anecdote they keep telling me, is that when they left, the office at night, they would have to lock their door because they didn't want other people coming in and stealing their ideas. It was that kind of a little more of a cutthroat environment, where it's a little bit more individually, based off individual contributors, as opposed to group contribution and the whole group wins together. So what they ended up doing was they created their own firm, KKR. Even today, they did so many things to make sure that we never had that kind of a culture. And it was always, there's only one way to win at KKR, together. That's it. All right. So that was kind of the beginning. If you fast forward 45 years, we now manage $460 billion in AUM. So some of the world's biggest sovereign wealth funds, pension funds, retirement funds, insurance companies, all the large institutional investors are our clients. We have 1,800 employees from those first three that scribbled on a napkin in 1976. We're obviously in 21 offices around the world, and look, it's a pretty big firm. So one of the things that the firm has successfully done, and this is, in my mind, I think this is kind of the defining characteristic of the firm, is that they actually didn't evolve too much, except getting better and better at what they were doing in the US, but they didn't evolve too much until probably 2004. So, from between 1976, so for almost 30 years, the firm was, getting better and better, improving the returns, building a bigger team, getting better and better at certain industries in the United States. But they didn't go and do too much stuff overseas, except in Europe. From 2004, they sort of hit this strategic inflection point. And at that time, KKR decided that we were missing a lot of these opportunities, because sometimes we know an industry so well, or we know the situation so well. In fact, we know everybody on the board. The only problem is that the deal that's going to come out of it is not a private equity deal. It's probably going to be a credit deal, or an infrastructure deal, or something else. So what they did was, at the time, in 2004, they made the strategic decision that we're going to end up building a lot of these new business lines. We think that, by the way, that is one of our greatest strengths, is that sometimes when you meet a KKR person, that you don't know what the answer is, right? You might say, well, wait a minute, what's the problem? The problem is, I have this liquidity issue, but you don't know whether you could solve it with credit, or you could solve it with our infrastructure funds, which have a lower return than our private equity funds, for example, are intended to have a lower and more low risk return. So I think this multi-strategy approach for KKR is something that really has developed really in the last 15 years. And today, as you can see here, so only 40% of our AUM is under that traditional business of private equity, which is where I work. Yep. The other 60% is in infrastructure, natural resources, real estate, and credit.
It's still a pretty big number to be working with. Yeah.
It's a big firm. Yeah.
Great. Well, I mean, look, that's such an interesting history. I've never heard that story before. So thank you for sharing with us. What do you think? I mean, are you one of the earliest? Is KKR one of the earliest? And obviously, there are a lot of private equity or different strategies that are out there as well. What do you think differentiates yourself or differentiates KKR as a firm?
So I think I kind of hinted at it a little bit earlier. So we really think that our culture is the part that differentiates us. I know a lot of people always talk about this one firm culture. I mean, probably every multinational has some element of this. Maybe what we think the difference is at KKR is that we have decided that all the economics within KKR will be shared with all the employees. And it's not for everybody, because, for example, what it means is if you do the world's greatest deal in the world, you know what? You have to share that with every single person in KKR. All the other employees will get a small piece of it. And I personally believe in it, because what it does, it drives a culture of collaboration. And sometimes I won't have such a good year, so it's good that there's other people who are contributing a lot and will make sure that they cover up for my shortfalls in that year. But I think that's maybe the key culture, and you'll see it in the behavior. So whenever we announce a deal, the number of people that are kind of given credit for that deal is usually in the 30, 40, 50 people. It's not this other culture of, wait a minute, I was the only one or 3 people did the deal and everybody else sort of is not less important. That's not our culture at all. The other thing that we tried to do differently at KKR is we tried to build some very, very deep resources that we try to apply and apply to every situation that we're involved with. So just as an example, one of the developments we had in the early 2000s was we built a team called Capstone, KKR Capstone. So Capstone is a group of people that are operating executives. So usually they have, they come from consulting firms or they've run businesses before, and their entire job is to go into our portfolio companies and help them run better and drive operating efficiencies. Some of them will be procurement experts, some of them will be pricing experts, some of them will be in digitalization. So today, that's a big need that our companies have. And so they really go in and drive that specific initiative. Actually, and it creates a ton of value for us. So you've got this Capstone team. We actually have our own capital markets team because we do so many IPOs. We raise so much money from banks, et cetera. So our capital markets team actually drives a lot of those. We actually have a group called the KKR Global Institute, because geopolitics is now one of the key things you have to worry about when you're investing. So the Global Institute worries about geopolitics, societal needs, in general policy. You have to understand not just what today's policy is, but the direction of policy making. Yeah. It's headed by David Petraeus, who's a former general. I don't know if you remember him. He ran the U.S. force and allied troops in Afghanistan and Iraq. So, and then he was a director of the CIA. So he's a very well-connected
Probably
guy.
the right guy.
Maybe the right guy. He's got a lot of intelligence. So we have a macro team. We have we've got just a number of different teams that we try to add value to any situation that KKR is involved. So we think that kind of differentiates us because, for example, if I'm competing with usually a smaller firm in whichever location, but I have the benefit of all those resources to ensure that we deliver a better result. And then just very quickly, so this is again, it's a 45-year track record. Our long-term 45-year investment returns are 19% net of fees. So again, if you can earn 19% for 3 years or 5 years, but when you do it for 45 years, that's an achievement. And this is just some of the recent portfolio companies. So you'll see companies like Wella, which is the hair care business. Elsan is a French hospital business. MásMóvil is a Spanish telco. Seiyu is a Japanese retailer that we bought from Walmart. So anyway, just some of the examples of the kinds of companies that we invest in.
Yeah, well, I think consistency here is sort of the name of the game as well, right? To be able to have the resource base to continually, which is why you have such a large AUM, but also that your big LPs are, very comfortable with the team and the resources that are available to them.
That's right.
So maybe talk a bit about Asia. How have you seen the Asia PE franchise develop or evolve over the last few years?
Yeah, so Oye, you kind of stole my thunder a little bit because you rightly said at the very beginning of this that in a way we think about Asia or this concept of Asia as being kind of a fiction, right? Because if you look at Korea and Southeast Asia or Greater China and Australia, do you see a ton of similarities? Not really, right? So we made a decision when we entered Asia more than 15 years ago that we were not going to look at it as a single monolithic type of region that we had to enter, but rather we thought it was really about having 6 different regions and trying to field a good team in all 6 regions. So we think that gives us certain advantages. So as I mentioned before, so we really are trying to have a top 3 team across all 6 regions. The advantage for that is if you just look at my team in India, I have 42 people in India. Not all of them do PE, only 10 in PE. But you've got a Capstone team, a credit team, et cetera, et cetera. What that means is if I compete with somebody who has a much smaller team in India because they're only in private equity, but I've got 42 people and 42 times people who are developing relationships, hopefully went to school with the right people and that we're trying to get to know, et cetera, et cetera. So we just have an advantage of scale and idea sharing, relationships. So what we try to do is be as local as we can across all 6 markets. And there's a lot of synergies. So for example, we get to know somebody on the private equity side, but actually the deal comes and it's a credit deal, so that's okay. Our credit guys will do it. And just to give you a sense, like there's a few business groups in Southeast Asia, which you talked about. We've probably done business with them 3 or 4 times. They may not be from the same product, maybe twice in private equity, once in credit, et cetera, et cetera. So that's kind of our modus operandi we want to be relevant and helpful partners multiple times to the same business group. The other advantage that I think it gives us to go deep into Asia and really have very, very local teams across the continent is that we think that there are going to be times that you're going to want to diversify towards or away from a certain market. So there's going to be times when, for example, the China market is really hot. And so, the good thing is we have 5 other choices, right? We can say, okay, well, that year we'll put more into Korea, more into Australia, more into India or Southeast Asia. And there's going to be times when, the India market is particularly attractive. And if you don't have a team there, the problem is you're going to miss it. So we have a view that if you have 6 choices, you're just going to necessarily drive a more consistent and better level of performance than if you only have 2 teams, right? 2 strong teams, and maybe there's some of our competitors have decided that they really are going to prioritize 1 market or 2 markets or 3 markets, and the rest, they sort of opportunistically look at. Now we have decided we're going to go deep.
Well, but also, these relationships take time, right? It's not like you rock up at an entrepreneur's house and say, I want to work with you, that he would necessarily say yes. So there's the building of trust that needs to happen as well. So the strategy around sort of having a strong local team is very important.
So you're exactly right. We have 1 expat in that entire 200 professionals. And he's been with the firm for, I think, close to 20 years. So he's, yes, we consider him to be an honorary Asian, but everybody else is Asian, is local from where they're currently investing. You rightly said that the relationships are really key in Asia. So I think, as you said, being local, having people on the ground for a long period of time, I think makes a big difference.
Great. Well, we'd like to spend a little bit of time on your growth equity platform, and what obviously for those the traditional, what you used to do, management buyouts and traditional, are sort of slightly different, right? And when you look at growth, the lens that you take is also very, very different. So, what do you think were some of the initiatives that drove KKR to build this growth equity approach and platform?
So good question. So we really started building this platform so we started really building a technology growth investing platform and a healthcare growth investing platform in 2015 and 2016.
Oh, that's very recent.
It's pretty recent. And the reason we started was because we realized that some of our big companies were getting disrupted by these tech startups that we had never heard of. Or we had, we were big investors in healthcare for many years, and we realized that, gosh, we better understand some of these trends which are changing, the way that healthcare is delivered. So, what we ended up doing was actually some of our own people moved across to this growth platform, and actually it was good because they understood the big private equity side of our business, so that when they moved across, we had the same consistent people, the same way of thinking, but we recruited a lot more people who came from a growth mindset. And so ultimately, we ended up building these two businesses. We call it Next Generation Tech and Healthcare Strategic Growth. So those are the 2 platforms. We're quite thematic in the way we approach the world. So when you think about tech, you might think more of the consumer internet names, right? Like an Uber or a Grab or a Gojek or whatever it is. But actually, that's a relatively small part of what we do. So we did do the Lyft deal, that's the competitor of Uber. So that's the consumer internet deal that we did. But a lot of our stuff is quite different. So if you look at this list, we invest in a business called iValua, which is, it's an enterprise software business. What they do is they actually help a lot of large corporations manage procurement. So it just basically makes procurement easier and more cost effective. There's a business here called Darktrace, which is a big, cybersecurity business, just got listed last year.
That's a big one.
That's a big one. It's an important one. Policy Genius is an online insurance marketplace. And then on the healthcare side, the focus has been on, Blue Sprig, which is, quite interesting. So today now, the focus on autism and, this is actually a business that actually helps kids with autism.
Right.
And there's I guess maybe the other one worth mentioning would be the medical device business called ADDX, where we partnered with some of the best executives in the medical device kind of startup business and backed them to grow that to grow a few different businesses underneath ADDX. So these are the types of businesses that we're investing in. The returns so far have been pretty good. So I think it's
I think taking the knowledge base and the infrastructure and really applying it to these sectors will be extremely, extremely powerful, right? Because if you think about some of these ideas, it's really about digitization of corporates and existing needs and things like that. It's not just about e-commerce, is it?
So that's exactly right. I think as a consumer, you get the part of that entire group that you see is the narrow slice, which is that touches you, the e-commerce side. But digitalization, as you rightly said, is much bigger than that. It's really when the corporates and all the industries start, shifting towards digitalization that you see like a really big change in those industries. Yeah.
Great. What are some of the? I know we have a. What do you think are some of the drivers going forward? I mean, do you see, what's going to propel it? Any policy changes within? What does KKR think about these areas?
Yeah. So look, I think what you and your clients have probably already noticed is that one of the things that's changing recently, and you can kind of see it on this chart, is that the number of listed companies is actually declining. Right, so it's not such an exciting prospect to be listed anymore. Sometimes it's easier to be unlisted, and what you find also is that the amount of venture capital funds that are there that are prepared to back companies for a long period of time to stay private, keep growing the business before they go public. It's actually so much capital is out there for that you actually might stay private for a much longer period of time. So if you just look at this slide, what it's saying is. The number of stocks listed in the U.S. is declining. The average age of those stocks is actually getting higher and higher. So in other words, there's no new blood coming in. There's fewer companies getting listed, and the median number of years from the VC financing to get to an IPO is just getting longer and longer. So this is a different way of telling you the same thing, which is that. Venture capital and growth capital are becoming bigger and bigger industries, and they need more capital, and we keep raising more money and profitably deploying it. So I think it's going to keep continuing.
Yeah, well, what's quite interesting is, there's a lot of public that sort of says, SGX privatizations actually is a global trend.
It's a global trend.
It's not just a Singapore trend.
I feel like we unfairly in Singapore kind of look at the SGX and say, gosh, Singapore's, why can't we do better in Singapore? It's not a single SGX issue. It's not a Singapore issue. It's a global trend. Yeah.
Yes. And we, at least at the ADDX level, also see that shift from public capital to private capital. Yeah. And indeed, if our investors want to express their investment views in growth and all of that, actually is better represented in the private markets, because that's where you see a lot of innovation. That's where you see, climate change solutions. That's all being driven at the sort of just below the public market level.
Yeah. That's exactly right. So, and partly it's because the public markets are not as well developed yet in a lot of emerging markets. So, for example, if you want to invest in some of the fast-growing trends are technology, right? So if you want to invest in Indian technology, there's no index that you can buy, actually. There's too few listed stocks, right? So, or Philippines healthcare. Again, where are the listed stocks in Philippines healthcare? I don't think there are many, right? So you have to hopefully find private ways to invest in it.
Well, which very nicely leads into my next question. So from your perspective, why does private equity make sense for an individual's portfolio? I mean, just set aside access and availability, but why would it make sense?
So I think it makes sense. First of all, maybe just to start, the good news is all of you, or if you are a pensioner, if you have a pension of any sort, you probably are already invested in private equity in some fashion, right? Because our biggest, as you see here, our biggest public pension plans globally have actually deployed a huge amount of money, and frankly, we've delivered good returns as an industry for the pension industry. So maybe coming to your question, I think you should take a look at what the smartest capital in the world are doing, the most professionally managed long-term capital, which is the pension funds and the endowments and sovereign wealth funds. And what you'll see is that they've now allocated 35% of their entire amount to alternatives. And within alternatives, 14%, which is the largest allocation, is private equity. So private equity, including growth capital, et cetera, right? And then on the right-hand side, what you'll see is, again, we are living, as you can probably see from interest rates, we're living in kind of a low-return world. Right? You can't keep your money in the bank. You can't like just buy, bonds, yeah, and expect your capital to increase, certainly at a decent rate. So 80% of the investors, those sophisticated investors, are saying they're going to increase allocation to private equity. And here's why, right? So again, when you look for returns, you shouldn't look at just 1 year or a short period of time, because you want consistent performance over a long period of time. So I would say, even though, of course, we look very good as an industry for the last 1 year because it's been a great market, I would say don't look at the 1-year returns. Don't look at the 3-year returns. Look at the 10, 15, 20, and 25-year returns. And even over that period of time, private equity has consistently beaten the global public equities index. Yeah. I think for me, what's of more interest is that it's an extremely resilient asset class. So if you, again, look at this slide, what you'll see is, private equity continues to make money through recession periods. Of course, you'll see that the difference between the blue dot and the red dot here is that the blue dot is top quartile, the red dot is the lower quartile, and then the gray bar is the median. And even the lower quartile returns are actually, quite decent over this period of time. So, what you'll see is it's just a very all-weather kind of an asset class. At KKR, our aspiration will be to obviously hit the top quartile numbers. And if I don't consistently hit that, you'll probably have to interview somebody else next time, because we're pretty. The bar's
very high.
The bar's high. The bar's high. Yeah.
Well, I mean, what's quite interesting as we observe, through this volatility in the last few years, is that the patient capital, don't get forced into positions, right, in the market. Yeah. So I think that's also why over time you see the ability for private equity firms, especially large ones like yourself, pace out might be exits or investments just because there's a bit more time and optionality within the structure of the fund, right?
So that's exactly right. So normally we don't invest more than 20 or 25% of our fund in any given year. So in a sense, you're automatically diversifying across different periods in the market. There might be a time in the market where it is a little bit expensive. But you know what? You'll only put a small percentage of your fund to work at that time. Really the way that we drive those returns is by picking companies where we think we can really do something exceptional with those companies, right? Like really drive the returns a little bit harder. Normally there's some operational issues that we think we can fix or improve upon, or digitalization can drive a transformation of the business model. So that's really what drives the return, not whether you bought cheap, you didn't buy cheap. You don't.
Well, and also I think, just reflecting on my experience, or just observing what's happening. Between sort of Capstone and your global connectivity, I think you bring a lot of value add to your investee companies as well, right? So again, it's not just about buy and sell. Yeah. It's how do you then add value along the way and make sure that the company is resilient along cycles.
That's exactly right. Yeah. So you want to be in the business of taking kind of more as you rightly said, the luxury of time is what gives our industry this big advantage, which is that we're not going to be forced into a corner to sell at the wrong time. Or we also don't, if somebody gives us, you can't give us capital in the middle of our fund, right? Our fund is closed. So if somebody gives us a bunch of capital and we're forced to invest, that will never happen to us, right? We can be very systematic about how we space out our investing. Yeah.
Okay. Well, the next question I had is actually, what do you think is the evolution of value creation in growth equity? And what is your current thematic approach to tech and healthcare?
Sure. So I covered some of the themes a little earlier, so maybe not worth doing that again. But if we just look at the evolution of value in growth equity, and I think actually if you just look at this slide, you could imagine that we were talking about my business in Asia. Many of the comments that you made, I think, apply to this. But what used to happen in growth equity, and you can imagine this, if you were the first venture capitalist to meet Steve Jobs, then it's a little bit about who you know. The first person to get to that entrepreneur wins the game. So that was kind of how it was maybe 20 years ago. Then 10 years ago, it really became a little bit more about understanding that industry better than, or even that sub-industry better than anybody else. That's still important. Like today, you need to understand blockchain. If you don't understand blockchain, you're going to miss something that's really important for the next 10 years. You need to understand, certain parts of digitalization, maybe in great detail. If you don't, you're going to miss, important investment returns over the next 10 years. So I think industry knowledge is really important. We think the next version of it is what we're trying to bring to the table, which is, there are people who, again, are well-connected. They go out and meet all the right entrepreneurs. There are people who even are very knowledgeable in that particular industry, but they don't have a capstone team that can actually go in and drive certain initiatives. So we announced an investment in the Philippines just, I think yesterday or 2 days ago. And it's just a small growth investment. But that team actually said, as we were discussing, said, look, I actually want your capstone team. And these are the 3 things I want them to do because I don't want to disturb my current team with it. And these things are a little bit outside. I don't know if my team has the right expertise, but they definitely don't have the bandwidth. I really want you to help us with it. So we were delighted because, again, we were kind of being invited in by some top entrepreneurs. By the way, the team is excellent. I'm sure they could do it. But if they request our help and we can add some value, of course, we'll be delighted. So I think the capstone angle, the fact that we have, I think there's people who are really smart at the industry and very well connected, but they don't spend as much time with policymakers as we do. They don't spend as much time with the thought leaders in ESG as we do, right? So that allows us to anticipate and add value to some of these companies in a way that probably not every investor can. So we think that's kind of the next evolution, which is, can we bring big firm resources to kind of very small companies? Yeah.
Well, I mean, as a startup, I would I sort of appreciate that concept, right? Because you kind of have a team and there's always sort of a little bit of a blind spot here and there, or a, sort of slight gap here and there. And I think if, there's a partner like yourself that actually sort of worked alongside and say, well, this is where you need to be, this is how, you develop that competency, or this is how we bridge that gap. I think that's very powerful because sometimes the entrepreneur may not know what he doesn't know.
It is, but so at the same time, like what I would say is, I've worked with so many entrepreneurs, and what I would say is, what makes them entrepreneurs is that they're usually really good at what they're doing, and they have that passion. They have a number of things. I saw that passion in Henry and George. The reason they built this business is because they had a ton of passion about building this kind of a business, and nothing can kind of take that away. So, from our perspective, the partnership of what we do well, which is slightly more institutionalized, bringing in a number of outside resources. But what we can't replace is that original passion that both those people have. And I think for me, it's a great partnership when you can have our kind of capital backing some of the world's greatest entrepreneurs. That is a great combination.
Okay, before I hand over to the questions from the rest of our audience, actually I have one more for you, which is the technology space has always been very big in the US and very big in China, and maybe sort of like big countries like Korea and maybe even Japan. What do you think is the landscape in Singapore or Southeast Asia in general? I mean, do you think? I keep thinking we're still very small, but it seems to me that every day there's a new unicorn that's popping up.
Well, so it's funny. They asked me this question about 3 or 4 years ago, when I think there was only maybe 1 or 2 unicorns in Southeast Asia. So it might have been Grab and Gojek, and that was kind of it. Nobody had heard of anything else like a unicorn in Southeast Asia. And they asked me this on a panel. They said, what do you think about Southeast Asia? So I said, okay, to the audience, how many unicorns do you think there's going to be in 5 years? Is it going to be 10, 20, 50? And everybody's like, 50? What are you talking about? Like, how could it possibly have 50 unicorns? Now, I had a little inside information because we had been talking to so many companies that we were dead sure that these companies are going to be unicorns. But if you ask, the number that I said was 100.
Wow.
I think I'm going to be right.
Wow.
So, okay, we've got another 2 years. Let's see. But okay. I think I'm going to be right because I do think that the explosion of very, very interesting technology businesses that you've seen in China, you can also see that many of those businesses, very few of those businesses have become global in scale, right? Many of them have been really powerful for the domestic market.
Yes.
But, we invested in ByteDance, which, we invested in ByteDance because we thought that it was a great China business. And we thought, well, maybe TikTok will succeed, but even if it doesn't succeed, this is a great business. Yeah. But TikTok did succeed. That was kind of the surprise. We're like, wow.
I can't get my kids off it.
The surprise was a Chinese social media platform went global, which we weren't expecting that. But again, it's a good result. I think that all of that stuff is just coming to Southeast Asia. So what you've seen in China maybe 10 years ago, you're starting to see the very beginnings of it in India. If you're watching some of the consumer internet IPOs that happened in the last 2 years, that's a really exciting space now in India. And you're only starting to see the very first few examples with Sea Limited, Grab, Gojek, and there's going to be a few more. So I think I'm going to be right. There's going to be 100 unicorns in Southeast Asia in the next 2 years. I hope we'll be able to invest in several of them.
Well, I remember 20 years ago, you were looking at that during the dot-com days here, right?
Yeah.
I think today the capital base, the approach, and the knowledge base must be far, far deeper today to develop these into unicorns.
I think that the other big change from 20 years ago is 20 years ago, some of those foundational technologies like smartphones, everybody having a smartphone, right? Or just the basic e-commerce and e-commerce logistics and payments over internet. So some of those basic things have been solved, right? 20 years ago, even that was very difficult because nobody had credit cards, nobody had, so the basic stuff was not there. Yeah.
All right, great. We'll move on to questions. Again, if anybody has a question from the audience, please pop into the Q&A box and we will try and deal with as many as possible. Okay, let's ask one about competition. We talked about deal sourcing, competition. Are you seeing fierce competition today for, with KKR? And, we talked a bit about the edge, but let's talk a bit about how the space is looking like with all the capital coming in.
So for sure we are, right? It's, I would say probably, 10, 15 years ago, it was a lot less competitive. Today, yes, it's a highly competitive business. I think that's true globally. It's not, it's not just in the US and Europe. US and Europe, of course, have been competitive for many years. But Asia is getting increasingly competitive. And what we try to do, and so last year is kind of a good example because last year was a year where the market was actually quite hot. And pricing for all the deals we looked at was high. So what do you do in a year like that? And how do you make good returns? The first answer is you kind of just stay disciplined. You know you're going to miss quite a few deals. And we did. We missed quite a number just because we couldn't pay the right price. The second is for the deals that you're going to do, make sure that you understand that industry extremely well. So you don't miss something. You don't miss something that's off. And then again, for us, the way we look at it is, part of the return comes from buying a company at the right price. But also a big part of the return comes from what are you going to do with that business once you own it? Are you able to transform it? Are you able to improve the operations? Are you able to drive efficiency? So it's that second part which you get more confidence about if you have a capstone team that can drive those improvements, if you know that industry really well. So just as an example, KKR has done so many enterprise software deals, many ERP systems, many accounting systems, et cetera. So when we just recently announced a deal in Japan called Yayoi, which is an accounting business. So we had the confidence to do that deal. It was not a cheap price, but we had the confidence to do it because we had done those types of investments many times. Yep.
Okay, we have one question here about where do you see the most future growth? This is an interesting one, China or India?
Oh, great question. Look, I'm still very bullish about the China market. I know that right now, if you just look at the headlines, I think people are sort of kind of more cautious about China. But I'm still very, very bullish about China. It's still a gigantic market in terms of the consumption growth, et cetera. What I didn't foresee, so 10 years ago, I wouldn't have foreseen that by now you'll see so many incredible technology companies in China. And again, the thing about technology is once you build that foundational layer, then you build that second layer, then you can build a third layer, right? The reason something like TikTok exists is because Douyin, which is the Chinese version of TikTok, developed a really smart artificial intelligence engine to figure out, hey, what do consumers actually want to look at? If they look at this video, are they likely to look at this other one or this other one, right? And so I think that it's sort of a virtuous cycle. So I'm very optimistic about China. I also think that people talk a lot about common prosperity. That is, for me, that's kind of, it's actually a positive trend, because what it's going to drive is environmental solutions. It's going to drive a little bit more focus on consumer privacy and consumer rights, et cetera. So it's going to drive some very positive things in China, and it's going to create new industries as well. So for me, I'm really positive about China. Of course, being a heritage Indian, I have to say I'm also positive about India. Because I do think that if you just look at what we've seen in China, that explosion over the last 10 years, is just starting in India. And by the way, and then after that, I think it's also just starting in Southeast Asia. So I'm kind of, if you want to ride the wave, I would say India and Southeast Asia. If you want to just stay with what I think is ultimately always a good thing, I'll stay invested in China.
Well, barring any surprises, right, common prosperity is also going to lead to a lot of ideas around financial inclusion, the mass affluent growth. I think all that have to sort of come together as well. Although, I suppose it's sort of trying to observe what the Chinese government wants to focus or not focus on. Another question around electric vehicles. I think that's a massive industry in China that the government is actually supporting very strongly, right? So there are still very big pockets of growth and opportunity in China. That's different from India.
I think that's right. And so, again, it's a similar, I guess, I think that's right. It's quite different than India. I think India will end up, continuing to be a services powerhouse, a global services powerhouse. I think the type of tech that will be developed in India will probably be a little bit more, international in its scope. And China will end up, will probably end up developing, quite a fair number of technologies. But now, for geopolitical reasons, it may be that certain Chinese technologies or certain Chinese businesses will find it harder to go overseas. So.
Okay, let's shift topic a little bit. And this is a topic that everyone on our platform seems to be quite interested in. What is KKR's view and approach to sustainable investing?
Yeah, great question. So, look, I think the first thing is we've been committed to this for many years. So we have actually quite a large ESG team within KKR. It's part of the KKR Global Institute and our public affairs team. And so what we've done, maybe even 10 or 15 years ago, is we ended up partnering with some of the NGOs that were actually big names in the space. We partnered with the Environmental Defense Fund. We partnered with a group called Business for Social Responsibility, BSR. And we partnered with a group called, we signed the UN Principles for Responsible Investing. So the idea is that we made this decision that we were going to adhere to a certain set of standards, et cetera. What does that mean in practice is that actually our ESG team, and we have a head of ESG here in Asia, he sits in my office. They have a voice at every investment committee. No deal will get done without the ESG considerations being part of the 100-day plan. Right. So meaning, and what usually happens is there's something that we find in a diligence when we are investing in a company that is not perfect. Maybe they didn't focus on, just as an example, fire safety or something like that. Right. So these are things that we have to get fixed before we make the investment. Right. So they are part of like the either the 100-day plan or maybe even part of the conditions precedent to doing the investment. So what we're trying to do is bring our ESG folks into the investment committee, into what we call our portfolio management committee, to be looking after all those issues. And what it effectively means is there's probably certain industries that have become deprioritized within KKR now, where you just think that industry is just not going to be able to meet our standards. There are other industries where we think actually if we transform that business, if we do a better job with that industry, with that company, we actually can make improvements. And in that case, we're actually making even a better impact, because if we left the company the way it was, it would not be, it would not be sustainable. And it would be actually maybe a negative contributor to our ESG standards. But if we actually took it over and we changed some of the things that they're doing, many of which, by the way, means we sometimes increase cost. We don't always do everything only for cost, but we hope that company ultimately, when we list it, will be appreciated for the higher standards and will probably be worth more.
Cool. So there's a question around COVID that, what's the expectation? I mean, we kind of see markets reacting a little bit last couple of weeks. Do you think COVID or the post-COVID will drive somewhat of a structural decline, or are you in the V shape, sort of going back to super positive territory?
I'm in the latter camp. Okay. So if I were to say, look, what are the themes that one should be looking out for in the next 1, 2, 3 years, right? As you think about making your own investment portfolio, I would say the first thing is we are pretty optimistic that there's going to be a strong recovery. A lot of stuff will come back to normal. Look, I can't promise it's going to be this year or next year, but if you have a 2 to 3, 5 year kind of time horizon, I would say the recovery, in my own personal opinion, is going to be a little bit like what you I don't know if you remember SARS, but you do. I'm sure you do, right? So remember, between 2003 to 2005, there was a nice run, right, when these economies were kind of recovering from SARS. There was a lot of pent-up demand, and a lot of business came back in a big way. And in fact, if you drew a line from 2002 to 2005, it would seem like SARS was like the one blip, but then you almost caught up to the 2005 number, right? So I think there's going to be kind of a positive recovery. Maybe that's the first thing to look out for. Second thing is, I think we're in a world where inflation is a reality, and one has to pay attention to it. As a result, we are more focused on not just inflation, but what does it mean? It means, supply chains. We just took for granted that, the supply chain is, the cheapest cost, and there's no problem with getting goods from any part of the world. But for so many reasons, and the fragility of supply chains we've just discovered during COVID is, wow, bottlenecks have appeared in many places. In certain industries, there's now a geopolitical element to supply chains, which again has changed the way that goods will travel. So instead of like a single global supply chain, we actually have now multiple supply chains, and certain countries will participate in certain of those. Do you know this energy transition trend that we're like electric vehicles and so on? Actually, it's inflationary, right? Because people have to spend a lot of money, and it's actually more expensive, whether the government is subsidizing it or not, but actually it's more expensive to go through this big trend towards clean energy, right? Of course. Yeah. So what it means is that inflation is kind of something that one has to contend with. We have, as a result, ended up liking collateral-based cash flows. We like real estate. We like infrastructure. We like businesses that actually, throw off a lot of cash. So that's kind of, and businesses that have some element of pricing power. So in other words, the worst business you can be in now is one that can't raise its prices if their costs go up. Right? But if the costs go up and the business can say, okay, well, look, the customer has to accept that we have to also raise our prices. Those are actually very good businesses to be in. And then the last trend I would, again, not a big secret, but digitalization, decentralization. I think you have to pay attention to digitalization. I think you are part of the decentralization trend, which is this, DeFi and not one single source or not one single central node for so many of these networks. So you'll be part of that.
That's it. It is an interesting trend. We could, I'm sure, spend the whole day talking about that. So there is a question around exit. I probably know the answer, but I thought I'd leave it to you. How, in KKR's thinking about exits, how wedded are you to the public markets, right? Because, if let's say the public markets aren't great, you can't do an IPO, what are some of the options for KKR in that scenario?
Yeah, look, it's a good question. I mean, we have found over the years that the more predictable exit is the strategic exit. Is selling the business to somebody that has synergies. Usually you can, argue for a higher price if somebody has synergies when they buy your business. So we're really not that wedded to the IPO. I think in certain industries like technology or certain consumer businesses, which people just love to invest in, technology stocks and consumer stocks. We can find that sometimes the IPO market is more attractive than the strategic exit, but usually we are trying to get the strategic exit because, again, we consider it to be an all-weather exit.
Well, I suppose the other flip side of the question is you talk about the Chinese, right? I mean, for sure, there's now a question mark about IPOs, whether they can do it in the US or not. And
so we think probably Hong Kong ends up being, the beneficiary of that, like the Hong Kong market. I think it'll probably, frankly, create some opportunities for private equity funds to help, some of the companies that are listed in the US delist and then move across probably to Hong Kong or perhaps to a mainland Chinese exchange. So I think actually, in a sense, private equity tends to benefit from these disruptions. Yeah.
Okay, this is an interesting one since you talk a bit about DeFi and chains. What is the KKR view on cryptocurrency, and what's the stance, and what do you think about that?
Well, so what I would say is we are still probably developing our stance. We're usually late to learn about these new industries, but when we learn it, then we start investing in it. So we have to date invested in a few companies that are either somehow in the blockchain space or in the in the blockchain / crypto space. We think so far what I could say is we think it's if you asked us 5 years ago or 10 years ago, we were not sure this was going to become a real asset class and an institutionalized asset class. Today, I think we are beyond that doubt. So I think our view is this is now one of the most actively traded asset classes in the world. I think it's a top 5 asset class. So I think you have to pay attention when something is a top 5 asset class. We do think that one of the key risks is going to be how governments perceive it and regulation. So we're just a little, when we invest in this space, we're always keeping an eye on, is this ultimately our government's going to be okay with this? Yeah. And policy sometimes takes time to catch up with technology, right? So you have to kind of anticipate that, well, if we know that the government in general has this view towards money laundering, well, how do we make sure that something that we invest in 5 years doesn't get regulated in a way that really kills that industry, right? So you have to kind of anticipate the regulation, and I think the most thoughtful and sophisticated crypto and blockchain players, I think, are anticipating it very well. They've engaged the regulators. They have been, quite thoughtful about, even if it doesn't exist in policy today, but what is likely to exist 5 years from now or 10 years from now. So my view is I think it's a really important space. It's not going to go away, but if you invest in it, be a little thoughtful about the regulatory issues that will no doubt be of importance over the next 10 years.
Well, let's see, right? The SEC is supposed to make some pronouncements quite soon, and we'll see where that goes.
Just on that space, the one thing I would say is that's an area where we think Asia is probably the leader. Okay, so you see, when we talk about technology, often people have this immediate reaction, oh, must be Silicon Valley that's leading, and then Asia will kind of learn from them. And in this case, I feel it may be the opposite. I think Asia's a leader, so I think you're going to see quite a lot of innovation here, and it's a very exciting space to watch.
Good. Yeah. Well, watch this space. I think
there's an advertisement for you, but yeah.
I mean, we're a blockchain-based company, so we can see what that technology could do in terms of reshaping many things, right? Financial services and just sort of the digitization. So, I mean, crypto being a slightly different discussion altogether in terms of investment class, but the technology is going to form the new base level. I mean, Web 3.0 or whatever, all of these new things. So this definitely is a space that everyone is keeping an eye on. And I think the Singapore regulators are sort of cautious, but they are very open. And I think that's been a very positive development for the fintech industry in general. So I think that's great.
Yeah, I think actually the Singapore regulators, I think, are frankly differentiated globally, right? In terms of how open and how forward-looking they're being on this.
Okay, I think we have time for one last question, and I will come back to this thematic. I wanted to observe on one of your pie charts, and your big clients are allocating 35% into alternatives and privates, and that's actually an amazing number because I've been 2-3 years ago looking at statistics that were saying it's 20 to 25%. So in a very short span of time, actually that's gone to 35. That's huge. Do you think this trend is going to continue?
I think so. So the reason I think it's going to continue is because when I started in the business, by the way, the number was probably 5. Okay, so this 20-something years ago is 5%. And as you said, you looked at a few years ago, it's 20-25%, which is right. And today it's 35%. I think it continues. The reason I think it continues is because at the end of the day, I think a lot of these pension funds are balancing the immediate needs of their constituents versus the long-term returns that they really need to provide to those constituents. And if they do, many of them are doing a pretty sophisticated job in managing those, which means that you actually, the thing that's most important to you is the return, right? If you can kind of manage the near-term needs, actually you need the return. And as I said, like if you just look at your entire portfolio as a top pension fund manager, you will see that over time, I mean, consistently this product delivers. So I do think so. I do think it stays. I think the natural question to ask is, well, the industry is already so big. How can it possibly grow? Grow from here? And I think the reason is because, in a way, this industry is becoming more and more important. I showed you charts on why the publicly listed companies are probably becoming less prevalent globally. And there's so many, I think a lot of companies will end up staying private for very long periods of time. Yeah. And it'll go from, being owned by a KKR to possibly one of our competitors to possibly coming to another competitor, to et cetera. So companies will end up, I think, choosing to stay private for long periods of time, and that's a perfectly viable existence. It's only because we grew up 20 years ago in finance, you 10 years ago, me 20 years ago, that we have this view that everything must go public. That's this kind of old-fashioned view that we had, but I don't think that's true anymore. Yeah.
Great. Well, I think we've come to the end of the hour. Certainly that hour flew very, very quickly. I know we can spend one more hour talking about further thematics, but I think that we'll leave that for another day. But thank you, Ashish, for joining us this evening. I hope that everybody enjoyed this session. If you have any questions for the ADDX team, or actually even for Ashish, send them over. We'll try and get some answers back to you. And thank you for joining us this evening, and hope to see you soon.
Thank you. And thank you, Oyi.
Oh, thank you.
Nice to see you.
Yeah.